Good morning, guys. I hope you're all well. It's Duncan here. Just going to stop running through what's been going on in the markets since I last spoke to you on Friday. We've certainly had a great deal to deal with. Now, obviously, I listened in on Monday. I know Steve's gone through a lot with you, but I'll just give you a quick recap on my take on what's going on. Now, we'll start with the 5 things to start the day. Now, I think this is the key. Calm returns. It really is. We saw a huge move. Now, bear in mind, I've been trading for decades now. I've been through a lot of major financial crashes. That's pretty much what we saw. But what was different with it is the ones I've seen historically. There's been a tangible reason. Now, obviously, we saw the disappointment to the Fed last week, but what was that enough for a crash? Now, what that shows is there's a couple of factors playing in, and as we go through this webinar today, I'll talk you through them. But the key thing is calm is returning. In the futures this morning, we're looking at just green. And we've seen that go across Asia into Europe, and like I say, in the US futures, it's looking like we're going to show that again today after we saw the same thing yesterday. So I think the best place to start would be at the triggers of this. Now, in my opinion, there's been a couple of triggers here. Now, obviously, we spoke through the Fed. You know very well what was missed by the Fed, what the market thought of it, and it's been quite interesting over the last few days seeing the various commentators. I listen to a lot of markets podcasts and obviously do the reading as well. But the commentators Friday, Monday, Tuesday were coming out and saying, look, the Fed's missed a trick, and even talking about kind of inter-meeting cuts. Now, when the markets are plunging on Monday, you start to think, well, that could be possible. It's not typical, and I personally don't expect to see that from the Fed. They're just being too cautionary. Now, the big triggers, I think, were the first hike, or I think I went through it with you last week. The first hike from Japan. That's really interesting, and I'll come to that in a bit more detail in a minute. But the second trigger, and the more evident trigger, was the poor data we saw on Friday. The payrolls number obviously was disappointing, but it wasn't just that. We came in at 114 versus 176 expected. Another thing that's been ignored a little bit. Well, I think from memory, the previous month was above 200. I think it was around about 211,000. That got revised down. Now, what I think's key there is the Fed were looking at a number above 200, and then we see revision. Now, often revisions are more often than not revised lower, but still, what they did and what the decision at the time, this number wasn't unknown. The previous one was, but again, I think I went through this when we spoke about the potentials of recession and the Psalm rule on Friday, was the unemployment rate. I kind of warned and said, look, watch out. If we see a number above 4.25, 4.5, then that's a trigger for a paper recession, or on paper recession, I should say. This came in at 4.3. Now, obviously, huge disappointment, and it makes the Fed look like they're missing a trick. And they're now going to be playing catch up. We're now going to see these aggressive rate moves. Particularly, I remember when we spoke on Friday, we were looking at, do they go 0.25? Do they go 50%? Now, look, the market is expecting 50%. I think that has to be a given, with a further potential 50 in November and potential 25 in December. So yeah, that's been a trigger. Japan, the poor data. Again, all the data comes into key now. Everything's going to be looked at through a microscope. But the core thing, I think we just saw a bit of a shakeout in the market. Even the Magnificent Seven, barring Nvidia, they hadn't impressed. They hadn't shown that show that they're getting an ROI out of AI, and perhaps potentially, and something they're going to have to learn about is how to show in your results, how to strip back within your results that you're getting the result, that you're getting traction out of AI. Bear in mind, that's why everyone heavily went for these stocks, because they're leaders, they're showing the way in AI. But yeah, obviously over the last day or so, we've seen in Europe things have pulled back. Some decent house pricing out of the UK. We haven't seen that for a little while. I can't really not mention the fact that we're seeing riots on the streets in the UK at the moment. We've got a new government here, and obviously we've got some kind of far right mouthpieces in media and in positions where they're kind of hiding those tendencies, stirring up what could be the more, I don't want to say the word stupid, but the more the people who are easily influenced, and we're kind of seeing that, but don't think that's I'm not going to say it's a major concern. It's something the government needs to tread very carefully in how they discipline these people. There's calls to bring the army in, but that would only kind of martyr the people that are doing it. I think legal challenge is the right way to be doing things. But anyway, that's not a core focus. But I think this is now. I've been speaking to Steve offline about the yen carry trade. This is huge. This is an enormous. We've seen like so many years of yen low and negative interest rates. Now, what in simple terms, I'm sure Steve went through this with you yesterday, so I'll just do it very quickly. It allowed investors to borrow money from Japan at next to no interest rate, and then just suddenly, then they can do with it what they want. They can go out, they can invest for a higher yield. Is that stocks? Potentially, all asset classes. But they've been historically, people have been able to borrow money from Japan at unbelievably low rates. Now, the first signaling, as I said, of the market of Japan signaling that this party's coming to an end, suddenly gets people. And bear in mind, we're talking billions and billions here. These sort of things can't be. You don't just go, well, I'll get out of my, I'll get out of this position. Because bear in mind, when you're paying back a loan, you need to liquidate what's on the other side of it. Whatever asset class or item is on the other side of it, you need to liquidate that. That would be and again, that's potentially why we're seeing stocks come off. All these contributing factors, a Fed that the markets aren't buying into at the moment, over cautionary Fed, and potential of people unwinding positions on the fact that Japan could have started an interest rate, but the pace of that. Bear in mind, the term soft landing has been used a lot. That applies to every central bank. Obviously, the Fed, they're not managing their soft landing. They, on the face of it, it looks like they're behind the curve, behind the markets, behind the economy. Um, uh, so Japan need to do the same thing. Obviously, they inevitably rates will be going up, but it's the pace at which they do. And overnight, we did see the Bank of Japan deputy governor try and play this down, and this helped. He's just saying, look, we're watching. We're not. Central banks aren't here to trash the markets. They're not here to spot. Then, if a central bank causes a huge move in a market, they're not doing their job properly. Price stability is the core objective of one of many core objectives of a central bank. So Japan came out last night to try and ease the markets, and that, as I say, European markets have been buoyed by that, as of Japan, and as I say, it's just looking like a sea of green. Again, just in the last hour or so, we've seen Disney come out with slightly better numbers. Now that's on the back of that's the park. I think on the very brief piece of it I saw, I've not actually found an article giving me any good commentary on it yet, but it looks like the park's underperforming, but the movie side of things, I think they cited into that too, showing really good returns and helping their stock. So that's one to watch at the open today. Now, one thing over the last few days, it doesn't always have to be the asset class that you're trading that you watch, because again, we spoke about the VIX on Friday, and I think at the time the VIX was around about 35. Bear in mind, a month ago the VIX was sitting at 11. 11 VIX low level means comfortable markets, no real worries on the horizon. Then by Friday when we spoke, we were up at the 30, 35 area, I think it was. But on Monday, we hit 65 in the VIX. This is huge. But again, that's come back down. We've seen that back down at kind of the 24 area. But this is another thing to watch. This really is. It's a risk trade. It's a carry trade. It's also got the carry trade involved in it. Now, obviously, I'm showing you this going back to the first data being 1985, which is obviously a long way, not relevant to what we're doing at the moment. But it just shows the job the Bank of Japan have to do. Support the market when we're down here. They have to concentrate on the interest rate side, but also they have to consider what they're doing from an interest rate perspective is not damaging what they want. However, at the moment, the Bank of Japan were having to put their hand in the pocket and physically intervene in the market to buy their own currency and sell either, I think they do it via dollar and euro yen, just to keep this down. But what's happened with the Fed, it's kind of played into their arms from a pure currency perspective, just appreciating their own currency. But keep an eye on dollar yen, because in my opinion, over certainly Friday, Monday, Tuesday, it was kind of leading the curve on what was going to happen to the rest of the markets. So yeah, that's definitely one to keep an eye on. Now let's just go through the market charts, asset classes. Now, bonds really interesting. I think again, I keep harping back to what we discussed on Thursday and Friday. But we were looking at bond, certainly in the 10 years, the one I tend to focus on a bit more. But we were looking at from a yield perspective, coming down from 5 to 4. But if things go wrong, an outlier of in time, we could see push towards the 3 level. We've pretty much been there this week, but things are turning around, and we are seeing that head back. The yield certainly head back to around about the 4 level. So it'd be interesting to see how that performs today. Now, if we look at the thing to bear in mind, the selling and the unwinding of the carry will come in waves. Now, when I worked at a bank and we were working a huge currency order of a couple of billion or something like that, you don't go to the market and show your hand in one go. If people are unwinding, things are going to stay heavy. Don't get me wrong, there's going to be pullbacks. Every time the market dumps, you get the people, the investors who like to pick things up on the cheap. Look at Nvidia, Apple. If a week ago someone had said, would you like this 10, 15, 20% lower, people would be ripping your hand off to try and get in on that. But what we're going to see over the next period is a bit of a battle. Will this carry an unwind story come to it? It certainly could. It's a distinct possibility. But will the buyers outweigh the sellers? But for now, obviously, there is a downside bias. Oh, sorry, that's what I'm talking about. I meant to be looking at the S&P here. But yeah, potential bearish. Obviously, we're green at the moment. Will that hold, or could we see the kind of sellers? But just keep an eye on the levels. It looks like we're trading around about 53.25 at the moment. I think, as Steve points out, back above 53.45 could be interesting, but let's just see how we fare on the downside. Very similar story in the Nasdaq. Obviously, we had the I wouldn't say disappointment, underwhelmment of the major techs. Nvidia is not out until I think it's 27th, 28th of this month. So a lot of eyes will be on that. And I was reading about the potential of the concern over the efficiency of one of their chips. So let's just go down now. Gold, obviously, I talked about risk with yen. Gold, another risk asset. We saw this huge surge Friday, Monday, but the bit of a correction, obviously, the opposite of what we're seeing in the stock market. Similar story for oil, just coming down. Obviously, the Middle Eastern tensions still dictating the pace of oil, because that's where we're looking at production, a bulk of the production coming from. Now, in terms of earnings, especially compared to last week, it's pretty light. As I said, Disney came out this morning. That was pretty decent. But again, it is just a lot lighter. Eli Lilly, Gilead tomorrow, a little bit worth keeping an eye on. But for now, the broader story is going to dictate what's going on. Let's have a look at the week ahead, because I think the key thing here is, and I touched on the fact on Monday, Tuesday, we were seeing a lot of economists, bank economists, fund economists, bemoaning the inefficiency of the Fed. Today, I actually had the first one fight back and say 50's not done for September. It'll be interesting to see if that story turns around, and the crucial thing is going to be the data over the next few days. So, next few days, and then the coming weeks. Right, I put this back to Friday, so let's just go to this week. Okay, so in terms of, well, US data, not a huge amount coming out today. Let me check I'm on the right day. Yep. Not a huge amount. I mean, the things to keep an eye on is, obviously, for those of you interested in oil inventories, always a volatile moment. But I think, jobless claims. This is something we really got, because we know employment data. Now, employment data are not always an exact correlation to unemployment claims, but if we start to see these unemployment claims start to creep up, again, that's another kick to the Fed and the lag they seem to be having, and this cautionary tale. So I think these ones are key data. The also other thing to watch is Barkin speaking. Barkin is a prominent member of the Fed. Now, these Fed speakers, what do they say? What, obviously, they, on Friday, it would, if you'd heard from a Fed speaker, it would have been tough on the back of the poor payrolls number, and the market reaction to their delay. But now, obviously, we've dealt with what's going on in the market and the wider considerations. So, but for me, these two pieces of data, the jobs claims, and obviously not data, but hearing from a FOMC member. Okay, guys. Now, as I say, we're seeing a little bit of a sea of red. I'm new to Trader 8 technical analysis, so I needed to get used to that. So in the coming days, I'll be a bit more hands-on with levels on charts. But as we can see here, it's a decent start to the day, but there's certainly plenty of volatility out there. So I wish you all a good trading day ahead, and I will catch up with you tomorrow. Thank you very much.